Welcome to Season 1 of Margin Talks by Finaloop, where we help explore the flow of money in e-commerce. Today I have Sam Kaplan on the show. Sam has probably at one point had all of the DTC darlings of the last decade's decks on his desk. He's currently a partner at 5 Seasons, a consumer growth equity fund. Previously, he led venture and growth investing at Birch Creative Capital, a family office of Tory Birch co-founder Christopher Birch. Sam, welcome to the show.
Thanks for having me.
You were on the board of one of the more successful exits in the last generation of D2C brands, being Chubbies. What did you observe in their growth on the way to a 9-figure exit to solo brands?
Yeah, so first off, I think you said it correct, as in observe, because what really made Chubby's work was Kyle, Rayner, Tom, and Preston, the 4 founders. And I think at face value or from afar, you look at Chubby's and you say, wait, this is a small TAM. You're talking about men's shorts. This is a low AOV category. They're operating during, rising CACs, and fit is an issue in this category. So return rates naturally are going to be high. And, it became kind of an ongoing joke in board meetings that you guys picked the hardest category possible to build one of these brands in. And yet, they ultimately made it work. And there was choppy years in between for sure. There was a 3-year period where top line was just about flat, but bottom line improved by $20 million plus. They made every hard decision, both personally and professionally, hard decisions around team. It was a 4-founder group. So naturally, as the business grew, kind of siphoning off functions was really important. All of the founders moved from San Francisco to Austin, primarily to keep costs down. But throughout that, what they probably did the best, and some of the best of any kind of brand over the last 10 to 15 years, is maintained an extremely strong core brand that everyone knew what it stood for and everyone loved. I can't tell you how many board meetings we sat in where it was a topic of conversation from one of the board members. You guys should expand into pants. And the entirety of the brand out of the gate was say no to pants. Have
Yep.
fun. I think it's kind of a DTC lore that when they raised their seed round, they were running around New York in sub-zero temperatures in their shorts. And if you look at the brand today, which is, well more than 100 million of sales and extremely profitable, what you'll see is they still don't make pants. And that was 7 or 8 years pre-exit of telling everyone in the room and everyone out of the room that we know what we're doing. We believe in it to such a strong degree that very little that you say is going to nudge us off of our brand's path, even if operationally we're willing to make the changes.
That's so interesting about the no pants at board meetings. Because now that you mention it, I wonder if anyone even suggested, hey, can we have the 5-inch inseam, 7-inch inseam, but also add a 9-inch inseam? And they were like, no, it's only max length 7 inches.
Absolutely. And I think it's funny because also as they expanded categories and, obviously they ultimately were acquired by Solo Brands, which as the maker of Solo Stove, acquired them as part of a kind of outdoor roll up. When they launched outdoor, which became one of their best-selling categories, particularly during COVID, naturally you think hiking, walking through the woods, etc. You want more coverage versus less from the elements, from, the critters, from, all of that. And even so, they wouldn't move away from it. And they said, actually, on the contrary, the quality of content that we're going to be able to produce of a big burly man hiking around the outdoors in a 5-inch inseam is so far and away more important than the extra 5% of customers who don't believe in the brand today that might be attractive if we have a slightly longer short.
I can't remember which of the 4 guys said this, but I remember many years ago, they said they thought about the business more like The Daily Show than they did as an apparel business, that they were kind of a content machine built around kind of humor consumption for their audience as much as they were making shorts, which at the end of the day, printed shorts are somewhat commoditized. I'd love to hear kind of how investors and the board are thinking about the investment into content, which is sometimes ephemeral, hard to track. Yeah, how did you guys think about that?
Yeah, and as you said, they were complete trailblazers in that department. I think, as one of what I would say the ecom, native 1.0 brands alongside, Warby Parker and Birchbox and Bubble Bar and, all the brands that we know, what they really understood early on was exactly that, which is we're a content company. We're not necessarily a product company. And accordingly, let's actually bring the best people around the table to create content. And so I'm not sure how much they've spoken to this kind of publicly, because I think at that time probably no one really cared. But in the early years of the brand, their entire marketing team, or quite a few of them, were aspiring stand-up comics, and much more so than the I'm a growth hacker digital marketing type. And their belief was that if we can create better, more meaningful content for our customers, they're going to, relate to the brand in a way that if our product is on par with competitors versus, needing to be significantly better, they'll still choose us. And I think as the brand grew, that was and continued to be their secret sauce, because several companies popped up that were, in some cases, directly copying their content. There actually was even a situation where another company's homepage was a piece of our content that they had just copied and pasted. And their point of view was, yeah, that's annoying, but it doesn't matter. They can copy that piece, but the next 500 pieces of content that we're going to produce, they don't have the capacity to produce. And that's what's going to keep our CACs down and our customers loyal, and ultimately our unit economics palatable as we, grow a profitable brand.
Is it surprising to you, or is it quite obvious given how hard it is to do consistent content execution that 10, 15 years on, most brands still don't invest with the same intensity the Chubbies did in those early years?
I think it takes a certain investor group around the table. From my side, as you mentioned, I was working for Chris Birch, the founder, co-founder of Tory Burch, who is a creative himself and looks at businesses certainly as brands, and perhaps had a bit more of the stomach, not just to be okay with it, but to encourage it, because he was extremely aligned with them. I think it's very hard today for early stage companies to look themselves in the mirror, or really look their investors in the mirror and say, we're going to spend money on brand, and we don't know what the ROI is going to be. And in fact, the ROI today is probably going to be limited, even if we were able to measure it. But what we're doing is we're putting in place the principles and the pillars of what everyone should expect from us 5 years from now, 10 years from now, and if we're lucky enough to be around 30 years from now. And that is a brick by brick build. It's not a blast meta and get in front of everyone build.
Yeah, super interesting. We mentioned Christopher Birch. You started there around 10 years ago. A lot has changed in the consumer landscape, the consumer investing landscape. What do you think is the biggest difference investing 10 years ago versus now?
So it's interesting, because I feel that I was extremely lucky to land where I landed because of who Chris is and his view of the world, which is he's fundamentally a brand builder, an entrepreneur versus an investor. And I can tell you that when I was 25 and started working for Chris, and we were seeing all of the buzzy DTC businesses coming through our door, and every time his answer was, no, your unit economics don't work. Your CAC is too high. I don't understand. You're a fidget business. Make a fidget, sell it for enough money to make a profit on said fidget and buy more of them. And I was miserable for about a year at least, talking to whoever would listen to me, friends, other investors. Oh my God, this guy, he's out of touch. He doesn't understand. We're missing all of these amazing deals that then I'm reading about in TechCrunch and hearing about from all of my friends. And ultimately, 11 years on, I can say it was one of the luckiest seats in the world for me to land in, because I think what you hear now on a lot of podcasts like this is exactly what he was saying to me then. So that's a huge level of differentiation in the investor community, in that professional and institutional investors look at profit and unit economics much more forensically perhaps than they did in the past when they were really looking at growth. But the other thing that I think has changed a lot is founders. So founders understand the game, and they understand much more so what it means to take on an investor today, how their life is going to change accordingly. And I was listening to a sports podcast the other day that was talking about how polished young athletes are today, that you can put a 21-year-old in front of a reporter on ESPN or BBC, and they sound like a politician. And I think the same thing has happened within founders. And accordingly, as an investor, that has raised the bar, because while I'm, interviewing or asking founders about their business and making my own assessment, much more so than in the past, you're getting that right back from the founder.
Yeah, no, that's super interesting that there's now been a decade of content being shared in the founder community on different kind of content mediums to better educate founders about what investors are looking for, how to manage board meetings, how to think about follow-on rounds, signaling, all of that.
Exactly. I don't say it in a trite way to say that, well, founders know the game and accordingly their pitch decks are smoother and their stories are linear and tighter. I say it in a way that I think founders have really benefited from just being much more thoughtful about how they build a business from the beginning. And as a founder, you'll never have more freedom than you do from, say, 0 to 10 million of top line, because you can do whatever you want. And accordingly, those choices are yours, and you should really maintain them to be yours, because if you get nudged in a direction that you don't want to go by an investor or anyone else for that matter, it's much, much more difficult to make, a change back at 50 million than it was at 5.
Yeah. So let's stick with that theme, which is how should brand owners think about capitalization, and maybe through a combination of equity and debt, or maybe what you've seen on journeys from, call it 0 to 100. When should they think about their first equity raise? When should they lean into debt? When should they think about follow-on? What are some maybe guideposts?
Sure, and I think guidepost is the right word for it, because of course there's no one size fits all. I think first it's about going into your business with a very clear vision of where you think you want it to go, because ultimately that's going to impact every decision that you make, but fundraising, especially in the early days, is one of the most important. I think that for a brand in the US, things also look very different than for a brand in Europe. So this is category dependent, it's geography dependent, it's distribution channel dependent. But with all of that said, to not avoid answering the question, I think in the US, seed rounds should be a little bit bigger, because digital acquisition is more expensive. And ultimately, while we know and have covered that profitability has become really important to investors, there is still a minimum threshold of volume where you can start to attract an institutional investor, certainly at a Series A plus level. And so I wouldn't necessarily think about being profitable from 0 to maybe 5 million. What I would think about is ensuring that your unit economics work, and that what is driving a lack of profitability, if you have it, what is driving losses from 0 to 5 million would be things like team, things like infrastructure around the business, but a clear unit economic story that you can point to that says our contribution margin is positive. And accordingly, if you invest in me at 5 million, my path to profitability from an enterprise point of view is quite clear.
We've got Jacob here from Finaloop to help us decode some e-commerce finance best practices. Jacob, we had Sam here talking about evaluating positive contribution margin as a part of their investment criteria. Can you tell us what is contribution margin and why is it important?
Yes, regarding contribution margin, which is really crucial, especially in our industry, direct-to-consumer industry with such significant COGS. More or less what the contribution margin looks at is your net sales, which we've discussed in previous times is pretty much your total sales, less all of your refunds, returns, discounts, promotions, etc. And then taking into account all of your variable costs, which are costs that change based on your amount of activity and sales activity. So we'll take into account all of your COGS, meaning your product COGS, your non-product COGS, like all of your manufacturing costs, your shipping in, tariffs, insurance, and all of your non-product COGS, which would also be included in this calculation, shipping out costs, pick and pack costs, merchant fees, etc. And it would also take generally your other variable costs into account, like variable marketing costs. Some calculations would just look at ad spend. Some would look at all of your other variable costs, which would not be, it's not your fixed marketing costs, the retainer that you're paying to your agency, but costs that would change based on the amounts of campaigns you're running, etc. All of those would be included in your line just above the contribution margin. And under that would be your contribution margin, which is, again, your net sales less your variable costs. And this is a really crucial margin KPI for brands in our space. And it really gives very good visibility into how robust your brand is. And in one way of doing this, and I've heard other like investors in e-commerce space looking mainly at the gross margin, but it's a similar kind of methodology, knowing how feasible and how robust and how good is your actual business model. Are you actually breaking even when it comes to your variable costs? Because if you're not, it doesn't matter how good your operating costs, your SG&A costs are, whatever you want to call them, under that line, you're going to be in loss position. And even if your contribution margin looks decent, if it's not good enough or high enough, then again, however lean you are on an operating side, you're not going to be able to make it. So being really on top of your contribution margin is definitely key to succeeding. And one last point, which we've discussed, which I think is really important, is if you can split look at your recurring revenue and your first-time revenue from customers who are paying for the first time. And if your contribution margin from your recurring revenue is greater than your fixed costs, meaning your SG&A, your OPEX, everything gets below that line, then you can take all of your contribution margin for growth or for pulling out cash or for generally you'd recommend growing your company. And that's a marker that we've seen time and time again of successful companies.
We're making some of these investments into content that will have a longer payback period, like Chubbies was doing. Requires a team, requires some content machine to build. But like you said, at minimum, gross margin landed, including cost of delivery, is very strong. Maybe contribution margin post direct marketing is still positive, and let's invest behind those metrics.
Exactly. I think, when we look at a business at a super high level, what we talk about internally is the holy trinity, which would be high AOV, high repeat, and high margin. It's the holy trinity because it's not common. And in a lot of ways, those metrics oftentimes cancel each other out. If it's a high AOV item, oftentimes there isn't going to be high repeat, but there should be high margin, and so on and so forth. I think what you touched on there, though, about these investments in marketing and brand specifically being done early and not necessarily having kind of the clearest ROI, as we've discussed, that's why you need the right investors around the table. And I think consumer tourists, so generalist investors that lean into consumer when times are good and it feels sexy and exit when it doesn't, are very rarely going to be the investors that are comfortable making a bet on a business that is making those kind of bets.
It's such a tough thing, the investment behind brand, because sometimes we'll see a $3 million revenue brand that's been in market for a few years, and they'll say, we've got a $10 million brand. And no, what does that mean? And I appreciate that you've got good taste, good aesthetic, and you've invested behind content, and you've even potentially got a social following, and all those things are worth something. But ultimately, you've got a $3 million revenue business. So what does that? There's probably just a lack of product market fit, even though your brand comms is really strong. So it's really the pairing of that brand execution with that holy trinity, plus some product market fit that's driving velocity. But yeah,
It's not easy.
It's not easy. You touched on kind of different geographies. Post-COVID, you made the switch to be based in London. Now you're with a European-focused investor. Yeah, talk us through some of the differences in mindset, European versus American, from either a investor or a brand standpoint.
Yeah, so I think on the kind of capitalization point, because it's an important one, particularly thinking about Europe, seed rounds in Europe are much, much smaller. And that tends to be for two reasons. One, just because frankly, the seed fund market is much less mature than in the US. So there are many fewer of them, which is true at each stage of venture capital in Europe. But also because it's really about building a local hero. That should be your goal from seed to Series A. And the markets, of course, are smaller. And accordingly, with your seed, what you should be able to do is when you come to us, because at 5 Seasons we invest in Series A and B, is say, I have broken product market fit and I am the number one or fastest growing XYZ in my home market of Sweden or Germany or the UK. And this next round of capital, I am going to use to either consolidate my market position by expanding channel or open up new geographies. And so typically you just need less capital in Europe. I'll start there. And that's also driven by digital spend is less, but there's less capital to find. And so I think while folks like to talk about the revision in focus in the US of both founders and investors on profitability, in Europe it's a necessity because the volume of capital is just that much lower. And accordingly, from the investor side, my belief is that our ability to choose is that much higher. It's just a bit less competitive.
You won't have 3, 4, 5 gut health probiotic soda companies, all with $50 to $100 million of funding, juking it out against each other.
Absolutely not. And I think what you tend to have here, especially post-COVID, is a market leader that came out of COVID super strong because the competitors that they had either washed away or raised at a super punchy valuation in 2021 that they're now wedded to. And the businesses that thrived during COVID came out and they are growing and profitable and strong. And I think the biggest difference from being an investor in the US versus being an investor in Europe is if you're an investor in the US, what you think about all day, every day is competition. If you're an investor in Europe, what you think about all day, every day is convincing the best entrepreneurs to take your money because the businesses tend to just be extremely sound, quite entrenched, at least in their home markets. And the founders are less drunk on venture capital because it's a newer industry and they didn't build this business with the idea that someone from Silicon Valley was going to show up at their door one day with a $25 million check.
Fascinating. You and each investment partner are only making a couple of investments a year. You've talked about the holy trinity, AOV, margin, repeat. Are there any other brand or company attributes that break through the noise to get your attention? Maybe categories? What else are you looking for?
Yeah, so I will say at Five Seasons specifically, we do a tremendous amount of internal research, which is not something that I did in the past at Birch. I would say at Birch, we were much more go out, scout. If you like a business or you like a founder, then let's get smart on the category. At Five Seasons, we typically do so in an opposite direction. Is a category interesting? If so, let's put together a material report internally and let's talk to every single company in that category in Europe and find the best one. So we're able to compare metrics across category and all of the competitors versus saying, well, we like a repeat rate of X in consumer generally. Next, what's the best company in that category? What does best mean? Oftentimes it's some combination of a beautiful brand that we really rate, a founder that we feel can bring it to the promised land, and the numbers that typically follow, those first two things. I think the last piece is, where does this business go from here? So we look at business growth levers being geography, channel, and product. Accordingly, what we need to see is, one, which of those growth levers are you prioritizing and planning to spend, the lion's share of our money or another investor's money on post? Two, do we agree with that and kind of buy that it's the right place to be allocating resources? And three, do we think the tail is long enough in this category, in these geographies, to ultimately get a business to 100 million plus of revenue, where, the 3 exits that we've done from Fund 1, we're all north of that number.
Margin Talks is obsessed with the flow of money in consumer. You've seen a lot of decks. You've also seen a lot of financial statements. We talked about unit economics earlier and that there's increased rigor in the last 5 years versus 5 years prior. But what are some other common financial missteps that you've seen brands take?
So I sound like a broken record here, but I do want to mention a few additional details on unit economics. Such a common refrain over the course of my entire career of investing has been, yes, the unit economics don't quite work now, but when we reach higher volume, our margins are going to expand because of economies of scale and factories are going to give us better terms. And I think what we know now is that almost never happens. And typically CAC increases a lot faster than gross margin does. Accordingly, if unit economics don't work today, they're never going to work tomorrow. Or at least that's how I look at things. And there are changes that you can make today as a pre-Series A company that you can't make tomorrow. Significant adjustments in pricing, sourcing decisions where if things go in the wrong direction, it may not be catastrophic. Where your warehouse is going to be, are you using a drop shipper or are you pick and packing, et cetera, et cetera. Outside of that, what I would say is revenue per employee. So there tends to be this obsession from a lot of founders of, we're going to build the platform that upon which we can drive a $50 million top line business. So yes, we're only doing 3 million today, but look at how great our team is. Look at how nice our office is. That's a little less common now. Look at how we've cracked the code on XYZ. Accordingly, yes, our G&A seems like a huge percentage of top line today, but actually we're really not going to need to expand it much if we 10x the business. To me, that is such a red flag, because what it tells me about you as a founder is that you spend money where you want to spend it, not where the data tells you it's most fruitful to spend it. And team in particular is one of the easiest things to at least market as a use of proceeds at a Series A raise. We built leanly to X. Core use of proceeds of this raise is put a more senior team in place. And I've looked at, businesses recently that are doing $750K, $1 million of turnover per employee, including businesses that are 50 million plus of top line. And $1 million per employee is absolute best in class. And, that for certain companies and categories, that's going to be impossible. But I think around 500K per employee in your early days as a business should be really what you're aspiring towards.
Jacob, Sam here talks about use of G&A and getting operating leverage. How should an e-commerce brand think about that?
Hey, yeah, so operating leverage kind of touches on the point that we discussed before, which is the contribution margin. And what it really does is it compares your contribution margin to your operating margin, which is another way of looking at comparing your variables to your fixed costs. And just the way it works is, like SaaS kind of companies, software companies, where you have a very big, very significant contribution margin because your COGS and a lot of times your variable spend in general is very low versus your OPEX, which is very high because you have all these R&D costs, is going to have a higher leverage because the contribution margin is higher than e-commerce type companies, which would have a lower contribution margin because of more COGS. But on the other hand, hopefully should have greater operating margin, or at least proportionally to the contribution margin, because of less fixed costs. So then it would be slightly lower risk because everything changes based on sales, as opposed to a SaaS company, which would have fixed costs no matter what. So you're leveraged, which on the one hand is great if you have sales, but if you don't have sales, you still need to make those fixed costs. I was kind of explaining what operational leverage is, and kind of keeping in tune with this episode, because e-commerce brands have generally lower contribution margins. The way to make it, A, just look at your operational leverage, and B is to, on the one hand, being on top of your contribution margin, like we noted before, which is by trying to A, increase top line and decrease COGS costs. And on the other hand, making sure that your operational costs are as lean as possible, because the top line is going to be expensive, to make your leverage hit industry benchmarks, which means be as lean as possible, especially on the SG&A side. Don't bring extra employees until it's absolutely necessary. Have a very scrappy founding team that could do as much as possible. Make sure each founder is contributing as much as they possibly can. Stay away from fancy offices, etc., to have the bottom part, the operating part of your P&L as minimal as possible to hit your profitability markers.
I think that first point, they're both incredibly insightful. I think that first point, we've seen a lot of financial statements, and we have talked to a lot of founders when we've seen 30% gross margins, net of cost of delivery. And they're like, how, you don't have much room below this. And it's exactly what you said. The response is almost always either like, we expect it to improve with scale, or we did expect it to improve with scale and it hasn't. And it's exactly as you said, often these brands are many years in and very hard to rejigger the supply chain without reducing product quality issues. Yeah, it can be such a killer. And then on the team thing, exactly as you said, it's what we talked about earlier, in fact, is finding that balance between we are investing in the enterprise value with some kind of intellectual property, whether it be brand or something else, yet we're not drunk on it. And the solution I think we think about and that we see with best-in-class brands is that you do have the 3 or even 4 co-founders, like in Chubbies' case, that are interdisciplinary, that are amazing hands-on tools operators themselves, where you can get the benefit of, I think True Classic is another great example of this, where they can probably run with just the co-founders, they really had to quite a significant scale, because they can do the media buying, the brand execution, the sourcing, the planning, that they're not immediately hiring a 7-person team underneath the co-founders to do that.
I think it's to put it in a one-liner, it's a red flag to have a COO, because when a business is that small, what is the founder doing if they're not operating the business?
Totally. As we wrap, Sam, this wouldn't be a consumer ecom podcast without asking, what's in your cart these days? What have you got your eye on? What purchase are you pondering yourself?
My brand matrix has changed a lot, because it turns out that it's incredibly expensive to ship things from the US to the UK. What I would say is that, of course, I'm completely brand obsessed, and accordingly, every day finding things that I love. I think, currently brands that I am totally obsessed with, Perfumer H, which is a niche fragrance brand based in London, has a truly phenomenal and differentiated product in a wildly saturated and lookalike market. Kimai, which is a lab-grown diamond jewelry brand that's just building a luxury jewelry brand that happens to use lab-grown diamonds instead of constantly talking and or apologizing or being bashful about the fact that they do. Mimetic is a biomimetic skincare business based in Paris. They have a cutting edge, basically biotech product that mimics your skin cells to repair imperfections, that I think is really differentiated and fantastic. And, to throw an American brand in there, I think Deadcool and what they have built with kind of highly branded, that's excellently executed premium homeware, like their laundry detergent, that's things like that are the things that make me miss living in the US.
Sam, for presumably European listeners, who should reach out to you, and how do they find you?
Yeah, absolutely. If you are a business that is building a brand in virtually any consumer category, come and find me. We tend to invest in businesses that are around 5 million plus of turnover. But with that said, we've invested earlier, and I always want to talk to people as soon as possible. I think when you take on an investor and when you make an investment, you're talking about a 4, 5, 6, 7-year relationship, and no one wants to meet someone once and get married. And accordingly, I love to find businesses earlier and earlier. You can find me at sam@5seasons.vc or on LinkedIn, and I hope to hear from you.
Sam, always so fun to catch up. Thanks so much for making the time.
Absolutely. And the feeling is more than mutual.
Thanks for listening to Margin Talks by Finaloop. Don't forget to like and subscribe on the channel you're listening to. If you have any questions or feedback, feel free to email me, fan@thehedgehogcompany.com. And if you'd like to see what Finaloop can do for your e-commerce business, please visit finaloop.com. We'll see you on the next one.